There is a narrow window in front of you. Not a year, not a cycle, not a decade. 1 month. 30 days that could redefine how you see money, risk, and opportunity. This is not about hype. This is not about fantasy projections or blind optimism. This is about understanding pressure building beneath the surface of the financial system. Pressure that is rarely visible until it is too late. For years, markets have conditioned people to believe that stability is permanent, that central banks can manage every crisis, that liquidity can always be injected, that paper promises can always be honored. But beneath that confidence sits a structural imbalance that has been quietly expanding. Debt has grown faster than productivity. Currency supply has expanded faster than tangible output. Financial assets have inflated faster than real-world collateral. Silver sits at the intersection of these distortions. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Unlike most assets, silver is not purely monetary and not purely industrial. It is both. It is a monetary metal with thousands of years of history as a store of value, and at the same time, it is a critical industrial input used in energy systems, electronics, medical applications, and advanced manufacturing. That dual identity makes silver uniquely sensitive to macroeconomic shifts. Right now, the macro environment is shifting. Inflation is not a temporary spike. It is the symptom of structural currency dilution. When governments expand deficits beyond sustainable levels, they must finance them. When financing costs rise, they face a dilemma. Either cut spending, raise taxes, or expand currency supply. History shows which path is chosen most often. Currency expansion becomes the path of least resistance. When currency supply expands faster than trust, purchasing power erodes. Silver responds to that erosion in stages. First, it lags. Then, it accelerates. And when it accelerates, it does not move gradually. It reprices violently. But inflation is only one component of the current setup. The hidden force building beneath the market is supply constraint. Silver is often misunderstood as abundant because its price appears low relative to gold. But price does not equal abundance. Much of the silver mined historically has been consumed in industrial applications and is not economically recoverable. Unlike gold, which is largely stored and recycled, silver is frequently dispersed in small quantities across millions of devices. At the same time, new mine supply is constrained. Silver production is heavily dependent on base metal mining. If base metal demand slows, silver output slows. Exploration budgets have been limited. Capital expenditures have been cautious. Environmental regulations have tightened. Bringing new supply online is not immediate. It can take years. Now combine constrained supply with surging demand. The global transition toward electrification requires silver. Solar panels require silver. Electric vehicles require silver. High-efficiency electronics require silver. As industrial demand expands, available above-ground inventory shrinks. That inventory is the buffer between normal pricing and price shock. When that buffer tightens, volatility follows. The next 30 days matter because markets are forward-looking. When traders begin to recognize a structural deficit, they do not wait for headlines confirming shortages. They position ahead of confirmation. The repricing happens before mainstream awareness. This is what creates asymmetric opportunity. An asymmetric opportunity exists when downside is limited relative to potential upside. Silver's historical volatility shows that when momentum builds, gains can outpace most other asset classes over short periods. In past cycles, silver has outperformed gold dramatically once confidence shifts toward tangible assets. Why could silver outperform gold again? Because of the gold to silver ratio. Historically, that ratio compresses during monetary stress phases. When confidence in currency declines, gold moves first. Then silver follows, often more aggressively. If gold reflects fear, silver reflects urgency. Right now, macro conditions resemble the early stages of previous repricing cycles. Real interest rates remain pressured. Sovereign debt levels remain elevated. Currency volatility remains persistent. Central banks are navigating narrow corridors between tightening and liquidity support. This is not a stable equilibrium. The smart capital understands cycles. It accumulates when sentiment is skeptical. It positions when volatility is low. It anticipates narrative shifts. That positioning is rarely announced. It is visible in subtle data: inventory drawdowns, futures positioning changes, premium shifts in physical markets. The next 30 days may determine whether silver remains range-bound or breaks into expansion. If silver breaks above key psychological resistance levels, technical momentum traders will enter. If industrial buyers accelerate procurement to secure supply, spot demand tightens further. If currency volatility intensifies, safe haven flows expand. Three forces converging at once create nonlinear price movement. But no opportunity is without risk. Silver is volatile. It can correct sharply. It can experience false breakouts. It can be influenced by broader market liquidity shocks. Understanding risk is not pessimism, it is preparation. The risk framework requires evaluating three dimensions: macro risk, liquidity risk, and positioning risk. Macro risk involves deflationary shocks or abrupt demand contraction. Liquidity risk involves forced selling during broader financial stress. Positioning risk involves overcrowded speculative trades that unwind quickly. However, the reward framework must also be evaluated. If structural supply deficits continue into 2026, if currency pressures persist, and if industrial electrification accelerates, silver's repricing potential expands significantly. Not gradually, exponentially. The concept of a 100x opportunity is not about silver rising 100 times in a year. It is about the leverage embedded within positioning early in a macro cycle. Physical accumulation, disciplined allocation, and strategic patience can amplify gains relative to risk capital deployed. The window is narrow because once confirmation becomes obvious, entry points become expensive. Markets reward anticipation, not reaction. The psychology of waiting is powerful. Many investors hesitate because they expect pullbacks. They expect clearer signals. They expect reassurance. But clarity often comes after movement. Ask yourself, what changes in 30 days? Inventory reports, monetary policy signals, industrial demand data, geopolitical tensions. Any one of these could catalyze momentum. But the deeper truth is this: the system itself is strained. Debt to GDP ratios across major economies remain historically elevated. Fiscal discipline is politically difficult. Entitlement obligations are long-term. Defense expenditures are rising. Infrastructure spending requires financing. When financing costs increase, the burden compounds. Currency becomes the pressure valve. Silver historically responds when currency credibility weakens, not overnight, but in waves. The first wave lifts gold. The second wave accelerates silver. The third wave captures mainstream attention. We may be approaching the second wave. Look beyond daily price charts. Examine structural trends. Central banks accumulating precious metals. Strategic stockpiling of industrial inputs. Regional trade realignments. Energy transition mandates. Each of these trends reinforces the case for tangible assets. But timing matters. Why 30 days? Because markets often move when positioning reaches extremes. Short interest can create fuel for a squeeze. Physical premiums can signal tightness. Future spreads can reveal stress. When these indicators align, price discovery accelerates. Opportunity favors preparation. To prepare, understand allocation. Overexposure invites panic. Underexposure invites regret. Balance is discipline. Consider liquidity. Physical holdings provide security, but limited immediate tradability. Paper instruments provide flexibility, but counterparty exposure. Strategy requires clarity of purpose. Consider exit planning. Euphoria often marks peaks. Having predefined targets prevents emotional decision-making. The 2026 horizon introduces additional catalysts. Political cycles influence fiscal policy. Trade policy shifts influence industrial demand. Energy infrastructure expansion influences silver consumption. Technological innovation influences material intensity. If silver demand growth outpaces supply growth, deficits compound annually. Compounding deficits reduce inventory. Reduced inventory increases sensitivity to demand shocks. Price becomes a function of scarcity. Scarcity is not theoretical. It is measurable. And when markets finally internalize measurable scarcity, repricing occurs rapidly. You are not being asked to speculate blindly. You are being asked to recognize structural imbalance. 30 days is not arbitrary. It is a period during which positioning can shift before confirmation becomes consensus. Consensus is expensive. Courage is uncomfortable. Preparation is rational. Silver embodies leverage to macro instability. It embodies leverage to industrial acceleration. It embodies leverage to currency dilution. When three leverage points align, opportunity expands. But remember, volatility is not the enemy. Emotional reaction to volatility is. The next month may test conviction. It may present pullbacks. It may present false narratives. Discipline will matter more than enthusiasm. Study the macro indicators. Monitor real yields. Track inventory data. Observe currency volatility. Watch industrial procurement trends. Knowledge reduces fear. If silver begins a breakout phase, the early days often appear insignificant, gradual. Then momentum builds. Media coverage increases. Retail flows surge. By the time headlines proclaim opportunity, much of the move has occurred. Do not wait for headlines. Evaluate now. 30 days can pass quickly. Markets can reprice even faster. If silver reaches 2026 with structural deficits intact and monetary instability unresolved, projections expand dramatically. Multiples become plausible that today seem exaggerated. But projection without foundation is speculation. The foundation is macro imbalance. And that imbalance is real. Act deliberately. Think independently. Position intelligently. The window is open, but not indefinitely. The second part of this message goes deeper. It moves beyond awareness into strategic execution. Because recognizing opportunity is only the beginning. Capturing it requires framework, patience, and resilience. Imagine two parallel paths. On one path, silver remains suppressed by short-term volatility, algorithmic trading, and macro noise. On the other path, silver transitions into a sustained bull phase driven by persistent deficits and currency instability. The difference between these paths may hinge on subtle catalysts that unfold within weeks. What triggers sustained repricing? First, confirmation of supply deficits through hard data. When quarterly reports reveal drawdowns in above-ground inventories beyond seasonal norms, it signals that demand is absorbing more than production replaces. This shifts perception from temporary tightness to structural shortage. Second, monetary policy shifts that prioritize liquidity support over inflation control. When markets anticipate easing in response to economic slowdown, tangible assets often front-run currency expansion. Third, geopolitical stress that disrupts trade flows or commodity supply chains. Silver production is geographically concentrated. Disruption amplifies scarcity. Fourth, investment flows re-entering precious metals as portfolio hedges. Even modest percentage reallocations from global capital pools can overwhelm limited silver markets. Consider scale. The silver market is small relative to equity and bond markets. A fractional shift in allocation from large asset classes into silver can produce disproportionate price movement. That is where exponential narratives originate. But exponential moves require ignition. Ignition often begins with disbelief. At first, skeptics dismiss the move as speculative. Then, as price sustains higher levels, skepticism turns into curiosity. Curiosity turns into participation. Participation turns into acceleration. Acceleration compresses timelines. If silver begins such a phase within the next month, 2026 could reflect compounded gains far beyond incremental forecasts. However, strategic positioning must account for volatility bands. Silver historically experiences corrections even within strong bull markets. Pullbacks of 15 to 30% are not unusual. These are shakeout phases designed to test conviction. Understanding this reduces panic. Capital allocation strategy can involve tiered entry points. Rather than deploying all capital at once, scaling positions across volatility bands reduces emotional pressure. Maintaining liquidity reserves allows participation in corrections rather than fear during them. Risk management is strength, not weakness. Now consider industrial acceleration more deeply. Electrification targets continue expanding. Renewable energy installations require silver-intensive components. Efficiency standards increase material intensity per unit. As nations compete technologically, advanced electronics demand grows. Unlike financial demand, industrial demand is price inelastic in critical applications. Manufacturers cannot easily substitute silver in many uses without sacrificing performance. This creates a baseline of structural demand relatively insensitive to moderate price increases. When investment demand overlays industrial baseline demand, tight markets become acute markets. The gold to silver ratio becomes a critical indicator in this context. If that ratio compresses significantly, it signals silver outperformance. Historically, extreme ratio levels precede strong reversals. Monitoring this ratio provides timing clues. Another dimension is currency confidence. When currency volatility increases globally, cross-border trade becomes uncertain. In such environments, tangible stores of value regain relevance. Silver, accessible at lower price points than gold, attracts broader participation. Participation expands demand breadth. Breadth sustains trends. The concept of 100x opportunity must be framed carefully. It is not about reckless leverage. It is about recognizing when probability-weighted upside dramatically exceeds downside. When downside is limited by production cost floors and industrial necessity, while upside is expanded by monetary instability and allocation shifts, asymmetry emerges. Asymmetry rewards preparation. The next 30 days may bring data releases, policy signals, or market moves that clarify direction. But clarity does not require certainty. It requires probability assessment. Ask, are supply deficits likely to resolve quickly? Unlikely, given development timelines. Are debt levels likely to contract significantly? Unlikely, given fiscal realities. Is industrial electrification likely to reverse? Unlikely, given strategic commitments. When multiple structural trends align in one direction, probability skews. Yet humility is essential. Markets can remain irrational longer than expected. Patience must coexist with conviction. Strategic execution also involves psychological readiness. Gains can create overconfidence. Corrections can create doubt. Having predefined rules prevents impulsive decisions. Define allocation percentage relative to total portfolio. Define scenarios for adding exposure. Define scenarios for trimming exposure. Define long-term thesis separate from short-term noise. In 2026, several catalysts may converge. Political transitions can influence fiscal stimulus. Infrastructure programs can increase industrial demand. Currency policy responses to economic slowdown can expand liquidity. Technological breakthroughs can increase material intensity. Each catalyst alone may not be transformative. Together, they can be. If silver enters 2026 already in a tightening environment, additional catalysts amplify momentum. But what if the opposite occurs? What if economic slowdown reduces industrial demand sharply? In that scenario, silver may experience temporary weakness. However, severe slowdown often triggers monetary easing. Monetary easing often benefits precious metals. Thus, silver possesses dual optionality. Industrial growth supports it in expansion. Monetary easing supports it in contraction. Dual optionality enhances asymmetry. This does not eliminate risk, it contextualizes it. Preparation over the next month involves education, allocation planning, and monitoring key indicators. It involves separating emotion from analysis. It involves understanding that volatility is inherent in opportunity. By the time mainstream narratives shift decisively bullish, risk-reward may be less favorable. Early positioning is uncomfortable precisely because consensus has not yet formed. The opportunity is not guaranteed. It is probabilistic. Probability favors those who act before clarity becomes consensus. 30 days can shape years. If structural deficits persist into 2026, if monetary instability continues, and if allocation flows accelerate, silver's repricing potential expands beyond conservative models. That is the framework. Not hype, not prediction without basis, framework. You are standing at the edge of a decision window. The market will not wait for hesitation. Data will evolve, prices will move. What you do within this window determines whether you observe the cycle or participate in it. The coming month is a test of awareness and discipline. Structural imbalance rarely announces itself loudly at the beginning. It whispers, through data, through subtle shifts in inventory, through small breakouts that few notice. Those who prepare early position themselves before momentum becomes obvious. Silver sits at the crossroads of monetary instability and industrial acceleration. If deficits persist, if currency pressure intensifies, and if allocation flows return to tangible assets, 2026 could reflect a dramatic repricing. The opportunity is asymmetric, but not without risk. Preparation, patience, and disciplined execution are the difference between speculation and strategy. The window is narrow. The choice is yours.